सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Any week that the RBI monetary policy announcement comes out, that entire week's news cycle surrounds that announcement. Before the announcement, people are talking about what will the RBI do. Once the announcement comes out, all of us talk about what it has done and what this means. And that's what we're going to discuss in this episode of Macrosutra. We're going to discuss what the RBI announced yesterday in its monetary policy decision. And we're going to see what implications this has on things like growth, inflation, liquidity in the banking sector. And so we have with us Radhika Pandey, Associate Professor at NIPFP, and I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And so now, Radhika, let's get on with it. So one, what did the RBI decide this time around, and was it either a surprise or not a surprise?
It was not a surprise at all. It was broadly expected that the RBI will keep the rates unchanged. Okay. So that is what it did. On the policy rate, they did not change the rates, and they kept it unchanged at 6.5%. And the reason for that is that, inflation has eased, but at the same time, growth is also strong. So growth does not require kind of a stimulus in the form of cut in interest rate.
Right.
While inflation has eased, there are some fresh emerging upside risks to inflation outlook, which the RBI governor discussed at length in his conference and the speech. He pointed out a number of upside risks to inflation, and keeping all these things into account, like uncertainty on monsoon, the distribution of monsoon, the uncertainty around El Nino and its potential implication on food prices, crude oil. We've seen that since Saudi Arabia has decided to cut its oil output every day by 1 million barrels.
Yes.
In addition to already the decision that they had taken, the OPEC Plus as a whole had decided to cut rates, cut the oil production. So this is over and above that. So these are all going to pose upside risks to inflation outlook. And we've seen some new decisions, like the central government has raised the minimum support price for Kharif crops.
Right.
Their impact will need to be monitored over the course of the months, and therefore, as a right strategy, the RBI has decided to maintain a status quo on rates, and it's a unanimous decision. All the MPC members decided to keep a status quo on rates.
So now, in my introduction, I had mentioned that there were three key elements. One is growth, inflation, and liquidity.
Yes.
So let's go through them one by one. Let's start with growth. What is the RBI's outlook on growth for FY24? We know that now the government data came for last year, showing pretty robust growth of 7.2%.
Yes.
What is the RBI saying for the
RBI
next year?
is also talking about, first it discussed the growth for FY23, where we have a growth of 7.2%, and for FY24 they have kept the growth projection as unchanged at 6.5%.
Okay.
But they are referring to a number of high frequency indicators that point to revival in growth, both in terms of investment, in terms of urban demand, in terms of indicators like car sales. On rural demand, the assessment is that it is still mixed. There are some indicators like motorcycle sales, three-wheeler sales that are picking up. On the other side, tractor sales are subdued. But overall, the picture on growth is that of resilience despite global headwind. And going forward, they do expect growth to remain at 6.5%, which is lower than last year. But overall, we don't see much threat coming from growth slowdown as of now. In the coming months, we saw yesterday the World Bank revise revised downward its growth projection for India
Right.
to 6.3% by 30 basis points. There are these discussions, the lagged impact of monetary policy tightening will have on consumption. Consumption had remained an area of concern even in the GDP numbers. So that will remain an area of concern.
Right.
But overall, if we see on growth, the position is much more positive, and the outlook is also positive. And that is reflected in the unchanged growth projection of 6.5%.
Right. And now 6.5% coming on the base of 7.2 in the previous year, that is a pretty strong growth rate, especially given what's happening in the world.
Yes, it is. So despite global headwinds, despite we are seeing trade slowing down, if we have a growth rate of 6.5%, it is a robust growth, and it's also being substantiated by a number of high frequency indicators.
Right.
We look at all the high frequency indicators, mostly they are showing resilient, they are presenting a picture of resilient growth, particularly the PMIs, or if you look at the bank credit, they are showing strong demand, which is also getting reflected in the growth numbers.
Right. Now, one thing that the RBI does is that it, along with giving the full year's growth projection, it gives it by quarter by quarter as well.
Right.
And now the numbers are showing that growth will be slowing each quarter over this financial year.
Yes.
Is that a matter of concern, or is that something that happens actually every year, where fourth quarter is slower than third quarter, which is slower than second quarter?
Yeah, so there is some amount of base effect that we will see in the initial quarters, this first half, but it's more of a picture of growth getting normalized. That is number one.
Okay.
And the second is they feel that the impact of tightened monetary policy will have a greater impact in the subsequent quarters. So that is why the subdued growth, or you can see we are seeing a subsequent lower growth projections for quarters.
Right.
That is mainly due to the fact that the monetary policy tightening will have impact in subsequent quarters.
Right. And now coming to inflation, the RBI governor actually made some significant points about how the central bank is viewing inflation.
Yes.
So what is their outlook? What are they thinking?
See, the key takeaway from the communication is that, look at inflation target as 4%, and the plus two and minus 2 is the band, but the inflation target is 4%, and that is what the RBI is committed to, achieving a 4% inflation rate, and their policy actions are being guided by achieving a 4% inflation.
This is
rate.
Something people often forget, right? They say, it's come below 6%, so that's good enough.
That's good enough. So, which is what he made a conscious effort to clarify, that the inflation target is 4%, and it's not just adequate to bring it down below 6%, but to bring it closer to the target of 4%, and all the policy actions should be guided by that. And therefore, we are seeing a very kind of hawkish tone, a more cautious tone towards inflation, which is getting reflected in the communication of the RBI. Also, their speech and their monetary policy statement, they are more cautious, and it's very welcome development that they are cautious, because globally also, if we see what is happening, look at two central banks, Reserve Bank of Australia and Reserve Bank of Canada. After maintaining a brief pause, they have increased the rates again. So that is what the governor mentioned also, that globally also, while it is fully acknowledged that headline inflation has come down, but it's very important to look at the composition, that it's shifting from goods to services inflation, which requires policy action. In the US, labor market is extremely tight. Look at the non-farm payroll employment. Look at the wage growth. It's extremely tight, and therefore it makes the task of the central banker very difficult, because you need to again tighten rates to bring about some kind of a slack in the labor market, which is what is happening in the US. They are again saying that, in June they might not raise rates, but July they will raise rates. So there is this understanding globally that inflation is still a problem, and therefore we need to look at the target. And the target is, for us, it's 4%. For the US, it is 2%. For the UK, it is 2%. the ECB also lifted their interest rate by 25 basis points.
Right.
So more or less, there is a cautious outlook towards inflation, not only domestically but also globally, which is a welcome development. That one should not lose the vigil over inflation till it durably comes down becomes closer to the mandated target.
Right. And now, before we get to the third element, which is liquidity, I thought that maybe we'd explain to our viewers what this rate being unchanged, what it means for them. How does it affect their loans and how does it affect their deposits? So if you could tell us a little bit more about that.
Yeah, so if we look at the rate, it is unchanged, and let us look at a very important policy variable, which is the real interest rate.
Right.
Now, what is real interest rate? It is the policy rate after netting out the impact of inflation.
Right.
So if the policy rate now is 6.5% and inflation, let us assume it's 4.5. It came out as 4.7, but just for ease of calculation, 4.5. So the real interest rate is closer to 2%,
Right.
which means that if depositors deposit their money, they are going to get at least a positive interest rate, because interest rates are now more than inflation. There was a time when inflation was more than the policy rate,
Right.
and the real interest rates were negative. So that is one takeaway, that deposit rates, at least the real interest rate is positive. But the other point also is that, which is intertwined with the liquidity position that we will be talking about. But just to give you a slight introduction, because of the 2,000 rupees that have been deposited into the banking system,
Yes.
the banks are flush with deposits, and they might not increase deposit rates further, because the banking system liquidity is extremely comfortable, so they may not increase. So that is again one implication, or downstream implication of interest rate and liquidity position.
Right. So, I mean, just to explain in a nutshell, the lending rate is, of course, the rate at which you take loans from banks, but the deposit rate is the rate at which that the banks give you interest for your deposits.
Right.
So banks typically raise their deposit rates when they want to attract deposits. But what Radhika is saying is that because their liquidity position, they have enough liquidity, they don't particularly need to encourage more and more deposits. And especially now, because of the 2,000 rupee deposit mandate that was put in place, they have enough liquidity. So your deposits right now, it's unlikely that they will start fetching more and more money in the future.
Right. On the credit side, we have already seen the EMIs rising because of the policy rate. But the fact is that now the policy rate has not been raised further, so we won't expect a further increase in the EMI. So that is a kind of respite for households, because we see most of the lending rates are now benchmarked to the policy repo rate, and it's very responsive. The lending rates are very responsive to policy rates.
Right.
Deposit rates are not that responsive to policy rates, and therefore we have seen a kind of a chasm between lending rate rising but deposit rates not rising. But in between, banks were inclined to raise deposit rates because the credit demand had risen so much that they had to attract deposits. So they started increasing the deposit rates, but that compulsion will now slow down a bit because they will be flush with liquidity in these months. So let's see how the liquidity picture shapes up in the coming month, because there will be a lot of factors going forward. But as of now, the picture is that the deposits and the liquidity position is comfortable, which does not give incentive for banks to further raise the deposit rates.
And now we were talking about the 2,000 rupee note, and there's one question from the audience, which is that did the MPC discuss the withdrawal of 2,000 rupee notes in its meeting and how that's progressing? I don't think it would have discussed it in the meeting itself, right?
So during the liquidity part, because there are two key decisions that are made in the monetary policy meeting.
Right.
One is on the policy rate and the other is on the stance.
Yes.
And on the stance, they again maintained the stance at withdrawal of accommodation,
Right.
which is again signaling a kind of a tight monetary policy that we are not yet done with policy rate hikes, because the stance is that it is withdrawal of accommodation.
Right.
Now, in this context, if we see the deposits of rupee 2000 notes, that has again increased the liquidity as we mentioned previously, and because liquidity has risen, that again gives RBI a reason to withdraw liquidity, because one of their important tasks is also to manage liquidity in the interbank system and to ensure that the call rate, that is what is the communication, that their liquidity management is governed by the fact that the call rate, which is the rate at which the banks borrow amongst themselves on an overnight basis, that call rate should be aligned with the repo rate. If the call rate is too much above the repo rate, that means there is a scarcity of liquidity, because banks are demanding funds and they are even willing to offer a higher interest rate.
Yeah.
Whereas if the call rate is much below the policy repo rate, it means that liquidity is in surplus. So they do all kinds of action that we can discuss in detail to align the call rate with the policy rate. And in this context, the 2000 rupee note has increased the liquidity and has resulted in bringing down the call rates even below the repo rate.
Right. And just to give you a snapshot of what the RBI governor said during the press conference about the 2000 rupee note, basically he said that at the end of the last financial year, that is at the end of March 2023, there was around 3.6.
Yes.
Around 3.6 lakh crore of rupees 2000 notes in circulation. And now yesterday, when he spoke in the press conference, he said that 1.8 lakh crore had been deposited into the account. So that's about 50% has come into the banking system. And about 83% of this, or in the 80s, around that much was to do with people depositing money in the accounts rather than just going and exchanging their notes. So this has a bearing on liquidity as well, if the bulk of the notes are being deposited rather than being exchanged. So that's the update that the RBI governor gave. Now, regarding growth, we actually have one question from the audience, which is that several agencies have kind of, as Radhika also pointed out, have downgraded India's growth estimate for FY24. So the question is that this year, some of the agencies are estimating that GDP might slip to 5.9%. Now, do you think that it is like this slowdown is possible because of the possible recession in the Eurozone and in the US?
So as of now, we have official or technical recession only in Germany, not in other countries of the EU. And it is also expected that Germany will also do better in the coming quarters. So on recession, there is a mixed outlook or kind of uncertainty, because inflation is also very high. Labor markets are also very tight. The reason why growth will slow down is not so much to do with recession, because one channel will be there that our exports will slow down. And recently, if you say even yesterday, there was a data point released from China that their exports have contracted by 7.5% because of lower global demand. Their imports have also contracted by 4.5% because of lower domestic demand. So that those factors are definitely at play, but for India, as we've seen that, it's the domestic consumption which is the mainstay of growth. It is almost 60% of GDP plus minus 1 or 2%. So if consumption remains strong, if investment remains strong, we should not see a significant slowdown in growth due to global headwind. What will impact growth going forward will be, as we mentioned, will be the lagged effect of monetary policy tightening, which has happened, because consumption tends to be sensitive to interest rates and also to inflation. So if inflation is controlled, if inflation is brought back within the target, that will have a positive impact on consumption and also on growth, because particularly rural consumption still needs to pick up, and rural consumption is highly sensitive to inflation, and therefore if inflation slows down, rural consumption will pick up. There will be more employment generation, people will have more income in their hand, so that will help in lifting growth. So definitely there will be a slowdown as compared to FY23, but the pace of slowdown will depend on how effectively we are able to manage inflation, because what we need to do is to ensure that consumption remains strong, not only in the urban areas but also in the rural areas. There should be a broad-based revival of consumption, and there should be a revival of private sector investment. Right now it's being heavily lifted by the government, but it should have a revival in the form of private sector investment at a more durable level.
And that's actually something that even the GDP data pointed out, right? Like the spending has been happening amongst the upper middle class, the rich, whereas the lower end of the spectrum, they are not yet back to, spending money on things like two-wheelers and all of that. So now also looking at inflation, the two big things that affect inflation really are oil prices on one side and food prices. Now, on oil prices, I mean, even though there are indications that in the global market oil prices might rise, aren't we kind of insulated from that because we have these channels of, getting oil from countries like Russia, which are giving us kind of subsidized oil because they have no other option. So, I mean, isn't that impact a little muted for India?
It will be, depending on how much we are importing from Russia. That is one. But right now the way Indian basket of crude oil calculation is done, it has still not been updated, and therefore we tend to see a magnified impact of crude oil prices on domestic crude oil prices, also the Brent crude oil prices on the Indian basket of crude prices. But on the other hand, there has been a welcome development where the oil marketing companies have suggested that because their financial position has improved, so there may be a reason to cut petrol prices or diesel prices in the coming month. So all these factors will shape. On the one side, the minimum support prices have been raised for Kharif crops by more than expected. So the expectation was 4 to 6%, but it has been raised from 5 to 11%. That may or may not have an impact on inflation. This will have this decision by the OMCs could have a very positive impact. So, and again, El Nino and food prices will have an impact. So all these factors will need to be seen, and also services inflation, which is picking up as evident not only from the Purchasing Managers Index surveys, but also a number of surveys that are conducted by the RBI. As mentioned in their policy statement, they have said that, RBI surveys are suggesting that both input costs and output prices are hardening. So the inflation outlook has to be driven by a combination of all these factors, both at the domestic level and at international level. And the second thing is, again, that they have very clearly communicated that it has to be 4% and not 6% or 5%, and they are not just okay with just bringing it down to 5%. So the target is 4%. So the benchmark is quite high, and therefore they will take all steps to ensure that inflation becomes within the range. And so the outcome of all this is that we don't expect cut in policy repo rate anytime soon, at least in the current calendar year. That is for sure.
So there you go. I mean, that actually encapsulates all of what the RBI decided. They kept the repo rate unchanged at 6.5%. The reason for this, they felt, was that the growth outlook for the year, even though it's 6.5%, even though it's 6.5% compared to 7.2% last year, 6.5 itself is pretty strong. So they feel that growth doesn't need any help by cutting interest rates, but at the same time, inflation is showing signs that it could again start going up. And so it's best to keep rates unchanged, because if they cut interest rates, then suddenly inflation would definitely go up. So they want to keep it unchanged, and that's why they've done so. Now, they've also made an important point that inflation, the target that they have and always had since they started targeting inflation, was 4%. It's not 6%, and it's not as if that once inflation has fallen below 6%, they can go easy on inflation. The target is 4%, and until it gets there, the RBI is going to keenly watch inflation. Now, that's all we have for you on this episode. But before you go, I have an appeal to make before you, which is that please subscribe to The Print. The link is in the description of this video. It allows us to do these kind of discussions, to do various kinds of videos that we bring to you. A lot of the ground reporting we do is enabled by your subscriptions. And apart from that, subscribing to us gets you a lot of benefits. It gets you priority passes to our subscriber exclusive webinars, where we talk to a lot of interesting people and we get their opinion about the news of the day or their analysis about what has been happening. It also allows you the opportunity to write in to us. It tells you, gives you the opportunity to write your opinion, and we call it the Your Turn section. You can write your opinion and we'll publish it. And finally, it also gives you access to our exclusive newsletters that go out from our editors straight to your mailboxes, where our editors discuss various ideas they have, regarding the news of the day, their opinions, and that comes exclusively to our subscribers. So please do subscribe. The link is in the description of this video, and thank you so much for watching.